This money on my street, I'm trying to get it out. My money's making money while I sleep. Financial wisdom, boy, we trying to eat. This money on my street, oh boy, you gotta practice what you preach. If you a hustler, then let's see you retreat. Money on my street, my money's making money while I sleep. Financial wisdom, boy, we trying to eat. This money on my street, oh boy, you gotta practice what you preach. If you a hustler, then let's see you retreat. Money on my street. Let's go.
Hello, everyone. You're listening to All the World Radio. I want to welcome you to the Money on My Street radio program, where we break down the complex topics of finance and bring them right to where you live. My name is Gavin Taylor, and I'm the pastor of the Love of Jesus of North Newark. I'm also a financial coach and a certified credit counselor. But today we're going to be talking about a topic that's really interesting to me, and I think really interesting to many people, and really helpful, I think, which is going to be the topic of credit. Now, I work as a financial coach and a credit counselor, and probably 80% of the people that I work with on a regular basis, they want to know how to improve their credit, how to raise their credit scores, how to eliminate things that are derogatory on their accounts. So today we're going to tackle some of those topics. I'm going to just, I'm going to take my time with it. You know, I'm not going to go through it too fast, so I may need a couple of programs to get through it all, but we'll just dig right into it. So today I brought a copy of my book that I wrote last year called Money on My Street, the Credit Repair Edition. For those that are watching live, they can actually see the book. But I want to read a couple of excerpts from it really quick, just to kind of set a foundation for today's presentation, today's topic. So on page 1, I do an introduction, and I label it the credit trap. And I just want to read just a couple of lines of that information. So I put here, so what is the credit trap? The credit trap is the name I use for the scheme that creditors and lenders use to keep consumers in debt for the rest of their lives. For example, have you ever walked into a department store like Macy's or one of these places, and as you are about to check out at the register, the person behind the counter asked you, would you like to open up a store credit card? Now, of course, you know, I'm sure that that's happened to you. And I don't know if you thought about it, but they're not asking you that because they're trying to be nice. Or even because they're trying to give you that 10 to 20% off the purchase that they tell you about. What they're really doing is they're setting you up for what I call the credit trap. You see, the owners of these department stores learned a long time ago that they can make more money off of credit than they could ever make off of any item that they ever sell in the store. You see, most department store credit cards have incredibly high interest rates, you know, like 25, 30%, and even higher. And so as the average consumer, what does that mean to you? Let me give you a little example. If you purchase $500 worth of merchandise at 30% interest, and you only paid the minimum payment, which is approximately, you know, just 4%, it would take you 58 months to pay off that credit card, and it will cost you $929.29. So that's $429.29 worth of interest. That's almost double the amount of the purchase price. That, my friends, is what I call the credit trap. You see, again, you know, they only ask you for 4% of the actual amount, but they're charging you 25, 30, or 35% interest. So you're not even paying the interest on the entire interest on it, let alone the principal amount. So that's why it takes people so long to get out of debt once they put themselves in it. So lenders use this over and over again, and that's why you're always inundated with mailings from creditors asking you to open up a credit card and stuff like that. Now, I know that what I'm talking about seems like a bad thing, but credit is actually a good thing. The issue is the debt, and we're going to get into that in just a little while. I want to read one more excerpt from the book, and then we're just going to dive all the way into this. So I want to read an excerpt from page 5, and it talks about credit being more valuable than money. And I put here, whenever I teach on the subject of credit, I always tell my students that having good credit could be more powerful than having money in the bank. Now, I always have many shocked looks when I tell people that, but this statement is not too far from the truth. Now, don't get me wrong, cash is still king, and I'm not trying to diminish the value of money or having money in the bank in any form or fashion. In fact, I encourage it. It's just that sometimes you can get more accomplished, financially speaking, with great credit and no money than you can have with money in the bank and poor credit. And I'm just going to share one example with you. When I purchased my first investment property, I didn't have a dime in the bank, but what I did have was great credit. Having a great credit score enabled me to get the home that I was purchasing without putting any money down. In fact, I was able to negotiate a deal that put over $15,000 of cash in my pocket at the closing. That's the power of having excellent credit. Now, you may be saying, I understand that credit is important, but how could it be more powerful than having money in the bank? Now, I say this because at the same time, I was working as a loan officer, and I had a situation with a client that convinced me of this fact. I was working with a couple that came into my office looking to purchase their first home. At the time, they had well over $20,000 in savings, but they had extremely poor credit. Now, I must tell you that it was incredibly difficult to get them approved for a mortgage, even though they had enough money for the down payment and closing costs. The issue and their hindrance was their poor credit. Now, I found this particularly interesting because I just purchased a 3-family home without any money to put down at all. But I jumped through far less hoops than they had to. The difference was because I had excellent credit. So I wanted to use these couple of stories just to kind of set a tone for why credit is so important. And most people don't realize it in their youth, and that's why many people destroy it before they can even get started. So let's kind of dig into this a little bit, and then I'm going to teach you some things that you can do to improve your credit if it's already messed up, how to keep it good if it's all right now, and how to make your score go even higher. So let's dig into that a little bit. So let's talk a little bit about why you actually need credit. Bottom line is credit is a huge part of your financial purchasing power. And we just talked about, just a few reasons why that's important. It helps you get the things that you need now based upon your promise to pay later. Now, the better your credit, the stronger your financial power is going to be. So what do you need credit for? Well, of course, the easy things to say would be to purchase things like a car or to buy a home. But you even need credit to rent an apartment. So you can't even rent a good apartment if your credit is jacked up, right? Also, something that's going on nowadays that didn't happen when I was younger is that you need credit or good credit to even secure most jobs. They'll check your credit for that. Now, I know a lot of people ask, well, why is that necessary? Why would somebody check my credit to give me a job? Well, your credit score is a picture of your responsibility, right? It tells people how responsible you are, or in other words, responsible you were in the ability to pay something back. So they will use that to determine your character, and whether or not you're a responsible individual. And so it also helped with things like securing insurance rates, like homeowners insurance or auto insurance or even life insurance. And it will, most importantly, determine the interest rates that you'll have to pay. Now, that's the real key. How much you pay in interest could determine, the difference between, I'll give you one more example. Buyer A is going to buy a car. They find a beautiful car that they like. They roll up, they get the perfect color. Everything is going great. They pick it out, perfect price. They tell the guy, look, I can't pay no more than $200. And they say, okay, and they take them into their little office. And they say, well, everything is great. All we got to do is pull your credit. So then they pull the credit. Now, that is the real picture. Now, that can jack your prices up that you thought you may pay $200 for up to $400 or $500, maybe even $600. While buyer B with great credit is walking out of the dealer with the same exact car, same exact color that you loved, paying $200 a month. So that's the difference that interest rates make. If your credit is not good, if they don't deny you flat out, they'll charge you a higher interest rate. So that's why it's important to kind of keep your credit good. Now let's talk a little bit about, again, the dangers of having that bad credit. Now, it can stop or it can hinder your ability to even purchase products and services that you need, or it can cause you to pay more for it than you should. And we just gave you an example of that. Now, remember, your credit will determine how much you'll actually pay for these things like a car, or whether or not you'll actually get that job, or where you'll be able to live. So that's the importance of credit nowadays. All right, so let's talk about the players in the game, and we'll get into credit reporting now and the credit reporting agency. So first of all, let me explain to you my definition of what a credit report is in my layman's terms. To me, it's the equivalent of like your high school transcript. So, when you go to high school, when you graduate, you get a diploma. Now, the diploma just simply says that you graduated, but it doesn't say what type of student you are. So when you go to apply for colleges, they don't just want your diploma, because that just says you graduated. They want to see your transcript, because that says what type of student you are. Were you an A student? Were you a D student? It paints the picture. And see, your credit report, it paints the picture to lenders that want to lend you money. It shows them exactly what type of financial student you are. Are you an A financial student? If you are, then you'll get excellent interest rates. If you're a D financial student, then you're going to wind up either not getting the loan that you're looking for, or you're going to pay out of the nose trying to get it. So real quick, let's talk about the players in the game. Where do these credit reports come from? So the three major credit reporting agencies are Experian, Equifax, and TransUnion. Now, these are the major players in the game. Now, each credit report is unique and different, and I'll talk to you a little bit about that later, but also at the same time, they're equally important. So you need to know what's on all three of your credit reports in order to complete that picture. And so I always tell people, you can't afford not to know what's on your credit. You have to know what's going on. You have to learn to be a student of your credit. Because if you don't know what's on your credit, when you walk into, to purchase certain things, you wind up getting disappointed. Now, let's go back to that car situation. I had a young man that actually came in that got denied for a car loan. Now, the bad thing about that is they don't even tell you why. They just tell you something is on your credit report. And then they tell you that they're going to mail you something later. So I'll tell you right now, the wrong time to find out that something is on your credit is when you're trying to buy something. You need to learn it prior to that so that you can start doing the work that you need to maybe fix it. I'll give you another example. I had a young man that I was working with that he was proactive. He sat down with me and asked me to pull his credit report so he could see what was on there. And we pulled his report and we checked it out. And we found out that he had, his credit score was was tanked. And he had no idea why, because he says, I barely even use credit, And we found out that he had all of these medical bills on his credit report. Now, the interesting thing with that is this, and it's the reason why if I have a son, I will never name him after me. And that's the fact that this young man, his father and him have the same exact name. And so they put this medical professional put all of the father's doctor bills on his credit report. And now his credit is completely jacked up. Now we were able, of course, to get it fixed, but we had to jump through, of course, a lot of hoops. You got to dispute a lot of things. You got to try to clear all of this stuff up. And it took months and months and months to do it. Now, again, this is something that was on his report for years. But he didn't realize it because he never checked his report until he walked into my office. So that's why it's so important for you to know what's on your credit report. You got to know what your FICO scores are. And I'll talk about that in a little bit. You need to know if anybody has tried to steal your identity. If you don't check your credit reports, how would you know? Now, in the state of New Jersey, there's no excuse. Most states only allow you one free credit report a year, but the state of New Jersey allows you 2 free credit reports. And you're able to pull them twice a year, every 6 months. Now, you can go to a place, I'm going to give you a website to check out. You can go to annualcreditreport.com. At annualcreditreport.com, you can pull all 3 of your credit reports. The only issue is that you don't get the scores with them unless you pay the additional fee for it, which is about $6 a piece. But you get all 3 of your credit reports, and that gives you an opportunity to take a look at every single one to make sure that they are accurate. You can also use, places like Credit Karma. Now, the only thing with Credit Karma is they only give you 2 credit reports, which is TransUnion and Equifax. And the other thing is they use a different scoring model. So let me mention this now. FICO, F-I-C-O, FICO is the industry standard. That is where most lenders are going to be checking your credit score at, especially when you buy major things like purchasing a home or buying a car or stuff like that. They're going to be looking at your FICO score. Now, Credit Karma uses the Vantage credit scoring model, which is a little different. It's becoming more popular, but still FICO is the industry standard. So when you look at your Credit Karma score, it'll be a little off. It'll be a little different than what your FICO is. It could be lower, and in some instances it can be higher, but usually when I see it, it's lower than the FICO score. So you can use it as, a gauge to see where your credit is, but in order for you to get your real credit scores, you want to get a copy of your FICO scores. All right, so you can go to annualcreditreport.com and you can get all 3 of your reports. You can pay for your scores. It's only $6 a piece, but it gives you that true picture. Also, I like to use Credit Karma just to check it throughout the year and just to kind of give me a gauge and an idea of where I'm at. So those are some ideas for you. Now, let's talk about credit scores. So FICO and also Vantage, they use a credit model with scores that range from 300 to 850. Now, 300 is the absolute worst. I don't think I've ever seen anybody with 300 credit score. Maybe it's out there. And then 850 is the absolute best. And I don't think I've ever seen anybody with 850 credit score. Usually people fall somewhere in between. So when you're looking at scores and you're trying to determine how good is my score once you look at your score, this is an idea of where you fall. So anything under 620 is a poor credit score. So as you're looking at your credit scores, this will kind of give you an idea. Right? Anything between 620 and 659 is considered fair. At 660, between 660 and 719 is acceptable. 720 or 700, 720 or higher is good, very good. And then 750 and up is excellent. So that gives you an idea of where you fall when you look at your credit scores. Now, during this pandemic, a lot of the lenders have gone up, in terms of where they want to be, where they want you to be with your credit score. So you need to make sure that your score is as high as possible. Usually I love for people to keep their scores above 700. And we'll talk about how you get it there and then how you keep it there. All right. But that's like the scoring. That's like an idea. So what makes up the credit score? Now, I always talk to people about this. Credit scoring model is not 1 + 1 = 2. It's not a very simple equation to figure out. And a lot of people get in trouble because they don't understand how credit scores work. So let's kind of go through that real quick just so that you can get an idea of what makes up your credit score. So we talked about the score itself, but this is how it's broken down. 35% of your credit score is based upon your payment history. So that's just, bottom line is knowing your payment date and paying it on time. It's just as simple as that. Making sure that you pay your bills on time, particularly, loans and things of that nature. Now, let me mention this while I'm here, because I may not be able to get to it later. Your credit is set up, the best way I can put it is it's set up in buckets. So let me mention this to you. Just because your payment is due on the 1st, that doesn't mean that your credit is affected if you pay it on the 2nd. So the way credit is set up, they're set up in 30-day buckets. So you are not late credit-wise. Now you'll be late with the creditor, but you're not late as far as your credit is concerned until you're 30 days late. When you hit 30 days late, that's when you get your first, asterisk or your first ding on your credit. The second one will come 60 days, followed by 90 days and then 120 days. But so they're broken down in 30-day buckets. So I always say to tell people to pay their credit on time, pay it by the time the creditor tells you to. But if you can't, just make sure that you're not 30 days late. Because once you're 30 days late, that's when your credit is affected. As long as you're within that 30-day period, your credit score will still be fine. All right, so 35% of your score is based upon your ability to pay on time. So never be late, because this will be the biggest ding or the biggest hit on your credit is going to be due to you being late. Now, number two, 30% of your credit or your credit score is based upon the amount owed versus the available credit that you have. So that's why I always tell people that credit is good. It's the debt that's bad. So you want to follow what's called the 30% rule. So in other words, you want to keep your credit underneath 30%. So for example, if you have, let's say you have a credit card that has a $1,000 limit. You never want to spend more than $300 of that, because now you're over your 30% threshold. And then it'll start negatively affecting your credit score. So never charge over 30% of your available credit. So this is what's known as your debt to income ratio, or your credit to debt ratio is a better word for it. Your credit to debt ratio. So how much available credit you have as opposed to how much outstanding debt you have. I always say this, pay your credit cards down to zero balances if you can every month. That's how you get caught up in the interest. That's how interest starts killing you. If you pay your credit cards off every month, then you don't have to worry about the interest killing you. Carrying balances is what causes the interest to catch up with you. So what I like to train people to do is you should always use your credit cards. You should always identify them and use them for certain things. So for certain things that you would normally pay cash for. So for example, if you buy groceries, pay cash for it. Instead of paying cash for it, use your credit card for it. And then pay it off. At the end of the month, you pay it off. If you have services like Netflix or like Hulu or things like, the Amazon, Prime, you have things like that, put it on your credit card, and have those monthly charges come out on your credit card and then pay the credit card off. Because you have to show activity on your card. So you have to use your card. But what you don't want to do is abuse the card. So use it for things that you would normally pay cash for. You can get a gas card and then use it to pay for gas. Or if you catch the bus, use it to buy your bus card every month and then pay it off. Things, again, that you would normally pay cash for. When people get in trouble with credit is because they use it to buy things to fund a lifestyle, as opposed to using it to just build their credit. So they'll buy big things, big ticket items, TVs and clothes and stuff like that. And then it takes them months and months and months to pay it off. And then they're paying interest out of the nose and paying double what they actually paid for in the store for it. So that's when people get in trouble with credit. So that's the 30% rule, which is keeping your available credit under 30%. But my primary recommendation is to just pay it all off. Now, this is a big one, and this is where I find that a lot of people get in trouble, and that is 15% of your score is based upon your credit history or your length of credit history. So the longer you have credit, the better your credit is. So let me give you an example. I had a young lady that mentioned to me that she had a great credit score. It was over 700, and her credit plummeted to in the 500s overnight because she listened to someone's bad advice, which was to close all your credit cards because you're not using them. So they closed every one of their credit cards out. And what they didn't realize that they did was they erased all their credit history. So all of those years of credit down the drain, gone. And with that, it took her 700 credit score with it, and down all the way down to 500. I had another person, and this happened to me. This happened fairly recent. I had a young lady that was talking to me about her credit, that credit score also fell. Now, what happened with her was a little different, but similar results. What happened was her longest credit history was her student loan. And she had been paying it for years, and she had just opened a credit card. So she had the student loan, and she had a credit card, and then in the same year, she purchased a car. So she had 3 loans, essentially. So she did what most would consider a prudent move. What she did was she refinanced her student loans because she wanted to get a better interest rate, and she wanted to lower the payment. So great. So you would think automatically, wow, that's a smart idea. That's fantastic, you know. But the issue is that was her longest standing piece of credit. So when she refinanced it, she started a brand new loan, and it started over again. She erased all her positive credit history, and her credit score tumbled. So again, if you don't understand how credit works, you can get yourself in credit trouble, and your score can plummet, and you don't even know why. So 15% is based upon your length of credit history. So if you have a long-standing credit card, don't close it if it's in good standing. Again, even if you're not really using it, use it for something that you can that you would normally pay cash for, just to keep it open. And mind you, you do have to use it, because if you don't use it, the creditor will close it for you. So if you leave it dormant too long, the creditor will close it. So you have to assign it to something. Again, you can assign it to gas or food, groceries. Use it for one of your services that you pay monthly for. But tie it to something so that you can keep it active. And then also you're not charging too much where you put yourself in debt and you wind up paying all of this interest, and something that you can easily pay off every month. All right, so that's 15%. So we got 2 more things to go. Now 10% is based upon, new credit. Or if you wind up opening too many accounts in a short period of time, it could also negatively affect your credit score. So if you start opening 3, 4, 5 credit cards at one time, you'll start seeing your credit score go down a little bit, because you're opening up too much credit in a short period of time. And then finally, 10% of your score is based upon how you vary your credit. So in other words, you need to have a good credit mix. So it shouldn't just be all credit cards. It should be some installment loans, So while I'm talking about this here, it's good for me to kind of give you an idea of what these things mean. So a credit card is what's known as revolving credit. So what happens, and so it revolves because, you have a limit on your credit card. It could be $1,000, whatever it is. Once you charge something on your credit card, that credit amount or limit goes down. So if you spend $100, it goes down to $900. But once you pay it off again, it goes back up to $1,000. So that's what it means by revolving, right? It continues. Now, installment loans, they have a period of time. So it could be, if you buy a car, it could be 3 to 5 years installment loan, right? So you're paying the same amount, generally speaking, every month for the next 3 to 5 years. Once that 3 to 5 years is over, then the installment is over, and you own whatever it is. Mortgages are also types of installment loans. Student loans are installment loans. And then revolving credit, like credit cards and also, home equity line of credits, things of that nature, are considered revolving loans. So that's what breaks up, or that's how the breakdown of your credit score goes. 35% is your payment history, 30% on your credit to debt ratio. In other words, the amount of credit you have in comparison to the amount of outstanding debt you have. And 15% based upon your credit history, or the length of credit time you've had credit. And 10% is based upon new credit or opening up too many accounts, and then 10% on your mix of credit. So whether or not you have credit lines and installment loans and things of that nature. So that's what makes up your credit score. So learning this will help you as you're making your decisions on purchasing things. You'll know what's negatively affecting your credit and what's positively affecting your credit. All right, so let's get in real quick, and I think my time is kind of coming to an end, but maybe I'll hold this to next one. But I'll talk to you a little bit about how to go about building your credit. I want to talk to you about some of the best practices. I don't want to rush through this again. I want to make sure that I give you enough time to get this information down. So this was kind of me laying the foundation and teaching you some things to look out for as you're checking out your credit. So my first recommendation is this: get a copy of all 3 of your credit reports. Get them today. You can go to annualcreditreport.com and you can get all 3 of your credit reports: Experian, Equifax, and TransUnion. Start going through them, review each report for accuracy. Make sure that there's nothing on there that doesn't belong to you. If there is something that doesn't belong to you, you can dispute it. You can dispute it online. You can dispute it in writing. But do that, and you can get it off if it doesn't belong to you. The credit reporting agencies have 30 days to verify whether or not that debt actually belongs to you. And if it doesn't, they have to remove it. Or if they can't verify it, they have to remove it. Now, I'm going to get into that more later on when I talk about how you repair your credit. All right, so with that being said, I want to thank you for listening to All the World Radio. You are listening to Money on My Street radio program. Hope you enjoyed this today. I'm going to say this in the word of my pastor, Pastor Jason Alvarez. He says you are blessed and you can't be cursed. We love you and can't wait for the next episode. We'll see you then. Hello, everyone. My name is Gavin Taylor, and I'm the creator of Money on My Street. Money on My Street is a financial literacy program and book series that was created to provide financial education and solutions to anyone looking to become financially independent. Financial literacy is the key to wealth accumulation. So we created our program to help families achieve their financial goals. Now we've turned our attention to the children. A Children's Guide to Wealth is the story of Samuel Taylor and how one trip to the toy store placed him on the road to financial independence. Through the teaching of his parents, Sammy learns about the value of money and how financial education can make him wealthy. The reason I wrote this book was to help parents with educating their children on basic financial principles. That equals $20, right?
Look, now you have $20.
Right, he had $20, but then he put 2 in his piggy bank. So how much do you have after that? 18. There you go. $18. As parents, it's our responsibility to teach our children about money so that they can learn how to build generational wealth. Helping our children to form healthy financial habits now will assist them in becoming financially independent in the future. To get a copy of any of the books in our financial literacy series, you can go to www.moneyonmystreet.com.